And really what it all comes down to is it's essentially a seller concession that you can mold into whatever needs to look like to meet those needs, whether it's a temporary buy down or a permanent one. And then even with temporary, that could be 3 years that you could utilize that tool. Could be 2 years, could be 1 year, depending on how much money you're getting from the seller. So, click, please.
I did. There it is.
I just want to say this is a movement created PowerPoint that I cut up a little bit. And I saw this and it was so poetic. I was like, we're going to leave it. Be the lighthouse for your clients. When they're as beacons of light, they provide guidance for safe passage to sailors and protect not only their lives, but the land nearby.
Hold on, I'm still ready.
But seriously, like as buyer's agents and seller's agents, like you are the lighthouse for those clients. Like, and especially right now, you can click to the next slide. Please.
Okay, let's go.
Everybody is afraid. Buyers are afraid, sellers are afraid, the market is weird and it's inconsistent. What's going on in Raleigh and Charlotte is different than what is going on here. So right now, I'm talking to other loan officers in other markets and agents in other markets, they're in different situations than we are here. It's not necessarily consistent anymore as far as like there's a shortage of housing everywhere. There's a huge surplus of housing everywhere. So there's a lot of unknowns. And so that's where you guys come in to be that lighthouse for clients, whether they're buying or they're selling, by bringing information and options like this.
Perfect.
So buy downs are a tool that you can utilize if you have buyers on the sidelines or you have listings sitting longer. Like this is something that you can take advantage of to help with both of those situations. It's not just something that will benefit buyers. Okay, you are spot on.
I've done this before.
A buy down is a way for a borrower to obtain a lower interest rate and the payment.
I know we live in Fayetteville, but yo, did you know how to pronounce buy?
You've got that. I saw that too, and I was like, why is there an H?
Well, why would we need that?
I mean, I would have put like B-I-E.
Or nothing.
Somebody Google it.
Or B-Y-E.
Google how it's technically in the dictionary. Because I'm wondering if they bullshitted that. Or
That's kind of crazy. Buy down? Bye.
Okay, let me
Sorry.
get back to my
Thank
you. It's a way for a borrower to obtain a lower interest rate, either permanently or temporarily, by paying either a one-time, well, it is all at closing, but
Mine's B-I-G-H D-A-U-N.
B-I-G-H. I feel like I would have
how to
really
pronounce it? Oh, yeah.
That's the phonetic sound of it.
Phonetic.
So it's open to interpretation.
Yeah, I guess.
Whatever helps you understand how to say that word properly.
It's like, thank God for this slide. I would
Next
never
slide.
I'm sorry.
Okay, so there's temporary, which essentially is where at closing, upfront interest is being paid to temporarily reduce the interest rate for a certain amount of years, 1, 2, or 3 years. With permanent, that is where you see people paying discount points. It's prepaid interest upfront at closing. Sounds like that's what you did. And then like everything is set at closing. Nothing fluctuates when it comes to the principal and interest payment that's being made every month. Wait, hold on.
Temporary buy down is when a party in mortgage transaction buys upfront interest to temporary. Yep. Permanent buy down has a lower interest rate for the entire term. So I think I've heard more about the temporary.
Yeah.
Do you do more temporary than permanent?
I mean, it depends on the market.
Yeah.
I mean, a permanent is where you see people paying discount points.
Yeah.
Whether that's a quarter of a point or a full point, that's a permanent. So, I mean,
Okay.
I feel like you guys have seen more of the permanent in the form of the discount points.
Gotcha.
Temporary has really only come into play in like the last 2 years when the market started to shift and rates went up. And, builders and builders primarily, started getting back into it first, and then sellers kind of have hopped on board with it.
Got it. And are you going to get into the cost of each one probably later?
I got slides.
I know, man.
I got slides on it.
All right.
So a temporary buy down is different from an ARM. So with a temporary buy down, the buyer starts making payments on a lower interest rate for a designated amount of time, and then it adjusts to the base fixed rate of the loan. So your actual interest rate on the mortgage is not changing. It's the same from the date you close until the very last payment on the loan. With an ARM, the buyer is making payments on a lower interest rate for a designated amount of time, but then the monthly payments change periodically for the rest of the loan.
Depending on the market.
Depending on the market, yes. So if rates go down and it's time for your loan to adjust, you're probably going to, adjust to a lower rate. But then that can also come back and bite you in the form of rates going up. And
yeah.
so I bet a lot of people who, were utilizing that product 5 years ago are starting to see that.
Did you see the chart of mortgage defaults?
Mm-hmm.
It's insane.
Yeah.
How is it going up?
It's way up.
Yeah.
It's crazy up.
But there's, I'll pull it up when we're done here. But there's another chart because there's, I think
it might be a fear chart, like
the one that you saw.
Yeah, probably.
I mean, they are up, yes, but when we look at it in comparison to like 2008, it's not even on the same playing field.
Gotcha.
But again, fear gets clicks,
right?
It gets engagement, which brings money. And so the only thing you're ever going to hear talked about on the news and circulating online is going to be whatever incites fear in people. You're not going to see the positive.
Do you do a lot of ARMs, or do you ever recommend ARMs for clients?
So I have not. Right now, the rates for... Oops, sorry.
That was good.
So, I mean, like in 2020, 2021, everything, like, why would you do an ARM? You're going to lock in that 3% forever.
Yeah.
It's never going to adjust lower than that. It's only going to go up from there. And then in the last few years, now that rates have been higher, the secondary market knows that all of these loans are temporary. As soon as rates go down, all these people are going to refinance. So ARM rates have not necessarily been better than fixed rates for the last few years because everybody knows that these are temporary loans. People are going to I'm already refinancing people that purchased last year from, a 7 or a 7.25 down into the low 6s or the high 5s. So, it's just commonly expected that like none of these loans are long-term loans.
Yeah. Do you ARM?
Yeah, but none of it's recording.
Can
Can
you mute it for me, please?
Yeah, sure. Here I go.
I was just gonna say, do ARM rates match what permanent rates are? Like, do they fluctuate, or do they fluctuate even more? Like, for example, if the going rate was like times 3% for a permanent, fixed rate loan, but an ARM at the time for that 3%, would it be like 2% or something like that? You know what I mean?
Typically, it's gonna in a normal world, ARM rates are typically better.
Yeah.
But rates are really determined when it all comes down to it. At the end of the day, they're determined by the market and what loans are being bought and sold. So, so right now, I mean, it depends on institution too. It varies from institution to institution. But in general, in the last few years, they haven't been competitively better.
Yeah.
Like to the point where it's like everyone's going out and getting an ARM,
Yeah.
It's because whether you have an ARM or you have a fixed rate, when rates go down, you're going to refinance.
Yeah.
So, all right. So the pros and cons.
Temporary.
Well,
Sorry.
yes. So for the temporary pros and cons, thank you, Ruben.
You're welcome.
Lower rate than permanent buy downs. Your money is going to get you a lower payment during that temporary buy down period than paying discount points for a permanent rate loan. The unused funds are returned to the buyer. Okay, this is a big one, and this is something I harp on with all of my people when I'm talking about buy downs with them. If you refinance and there is still money left set aside for your buy down, that money goes towards the principal amount on your loan. So let's say you do a 2-year long buy down, and after a year you refinance. That seller, not only that money paid for you to have a lower payment during that year, but they're also helping to cover the cost of your refinance. You're at no risk of losing that money. Whereas with discount points, if you refinance before you break even, that money's just gone.
Yeah.
So that money is protected by a buy down. The seller typically funds the buy down. It's immediate cash flow in that, you have that bigger savings, lower cost to the seller. Where that comes in is that there's going to be more bang for the buck by providing a buy down than by reducing the price of the home. And then increased appeal of the property. If it's, properly advertised. I've seen some agents that are like, we'll pay for a buy down, but it's like, nobody really knows what that means, or like you need to give a little bit more than that.
And what would that look like?
So, first of all, I would say connect with the lender, have the
Yeah.
lender run the numbers for you. And be like, okay, if you're, paying for a typical buy down on this property, it's going to be around this dollar amount, and it'll, help reduce their payment by approximately X amount of dollars each month. Because people see buy down, they don't really know what that means. They don't necessarily know
100%.
that that's going to give me a payment that's $350 cheaper for the first year and $150 cheaper, whatever, for the second year. So it does increase the appeal of the property if it's properly communicated.
Got it.
The con is that the buyer can't qualify for the lower rate. They have to qualify for the actual note rate on their loan. So if they're going to have a 6.5% interest rate, but they pay on 4.5% for the first year and 5.5% for the second year, they have to qualify at that higher rate. The relief is only temporary. And then the buyer would need to refinance if the market drops to lower rates, they have to refinance to benefit from that. So, but again, if there's money left over from the buy down, the seller's kind of helping to pay for that refinance, which is cool.
Any questions on that? Cool.
Oh, okay.
That's the next one. I know it looks the same.
Permanent pros and cons. The rate is fixed for the life of the loan. So if you bought down to a 5.75, then you don't have to worry about that payment changing as far as principal and interest goes.
But you can only do that for a
adjustment later
fix.
on.
Can you only do that for a fix? Because isn't that the point of an ARM?
You can do it with an ARM.
Really? And it sticks with that interest rate?
Yeah, because it's fluctuating by a certain amount.
Oh, it stays within like a
Yeah,
small
so like
window.
let's say it might fluctuate up to 2% for the first year, for example. If you have let's say you buy it down to a 5.5, then it can only go up to a 7.5. Versus if you have a 5.75, then it can only go up to a 7.75.
Oh, okay.
So you can kind of pick and choose even with ARMs. You can purchase down to a lower rate.
Gotcha. But so then it wouldn't really be fixed. Am I missing that? The interest
With
rate
an
really,
ARM, this is with like a fixed rate.
Fixed, that's what I was saying. Okay,
Yeah.
Cool. Okay.
Buyers can qualify at the lower rate because it is their permanent rate that you're buying down to. This does help in addressing the housing affordability crisis, because if you're buying down the interest rate, we'll get into this on another slide, but by keeping that payment lower, they can still qualify for those higher priced houses. You don't need to refi down the road, unless rates go down and it's beneficial, but your payment is not fluctuating, to where it's like, oh crap, I'm about to pay, X amount of dollars more a month as of this month and year. It just is what it is. Don't need to worry about job loss. Where that comes in is if you have a temporary buy down and you are banking on refinancing within that 2 years or that 3 years, when the rates go down, what if you've lost your job? And maybe now you switch to 1099 or your income has been reduced. You still have to qualify when you refinance. What if your circumstances have changed whenever the opportunity to refinance has come up? With the permanent route, you're already in that loan. Nothing is changing. So you could, hold off on refinancing and still have the same payment that you've had this whole time until you can qualify again. With temporary, it's like it would revert to the higher payment, and you're just gonna have to deal with it until you're able to refinance if there was a reason that you couldn't. Higher potential sales price, we'll get into that in another slide too. And reduced cancellations. Cons is that the buyer might need to refinance if rates drop below the buy down rate, higher rate than a temporary buy down. So your money is not going to get you as low of a rate in the form of discount points as the buy down will for that temporary period. And then you want to calculate the cost to break even. So, if you're spending $10,000 on a rate to save $42 a month, how long do you have to have that loan before you really and truly start saving $42 a month? Next. The offer. Okay, if you're placing an offer on a home and you want a buy down, or this is something that's really important to your buyer, then this is where it comes in to have a really great lender on your side who you can call up and be like, how much is the buy down going to cost for so-and-so on this property? You can pull that day's rates and get an idea of what that price point needs to look like. Because it is prepaid interest and it's based on the loan amount, cheaper houses are going to have a lower buy down cost. More expensive houses are going to have a higher buy down cost. So it might be something where you want to get closing costs and buy down money, or maybe they're like, we'll pay closing costs, but we want them to pay for our buy down. So how does a buy down work? They've got this wonderful piggy bank situation.
Good. I needed this.
Closing with a temporary buy down. So the loan amount is with the lender. The escrow account, you can see the big coin is the buyer, and then the little coin is their monthly payment where they're putting a little bit more into that every single month. And then for the temporary buy down, the seller is funding that piggy bank. And then once a month, a little bit of money comes out of it. Just give it a little shake.
Funny looking.
So essentially what's happening is the seller is financing the buy down into an escrow account at closing. And then during the buy down period, the amount of money needed to make the payment whole is going to come from that escrow account. So just for round numbers, let's say the payment's $2,000 a month. And the buyer is paying $1,800 a month for their first year of the buy down. The additional $200 to make that payment whole would come from the escrow account every month, and the buyer would pay the $1,800 every month, and then bam, the whole mortgage payment is made. And then if they refinance, whatever is left in the piggy bank is applied towards their principal balance.
Can anyone explain that here? If they were to, like, if your client says, hey, can you explain this to me real quick?
No.
It kind of requires a flow chart.
Yeah. I don't know if I'm a little lost. No?
So hold on.
Okay,
So,
good. I was like, come on.
let me explain it back to you how
Okay.
I understand
Oh, perfect.
it, and then let me see if I understand it right. So for a temporary buy down, right? Unused funds go back to the buyer, which is really towards the principal amount when you refinance. So let's say you buy down, or the seller buys down the rate, right? Let's say the seller
There's
buys
no point
down.
in the buyer doing it.
Yeah, let's say the seller temporarily buys down the rate for 3 years, and it costs $10,000. The seller spent $10,000 on that, right?
Sure.
Okay, and
Round numbers make it.
Yeah.
and then like 2-3 years later down the line, right? It makes that time comes. That temporary buy down is now about to go back up. So the buyer wants to refinance. So let's say the refinance costs $5,000. Any overages, so that $5,000 goes towards the buyer, but really it goes towards the principal amount of whatever that refinance
Yeah,
is.
whatever is left of that buy down money will go towards principal balance. Now, to note here though, not every lender does it that way. Some lenders keep it. Movement doesn't.
Hey,
Oh.
I know that.
And another thing is there's 1 year buy downs, 2 year buy downs, 3 year buy. Not every lender offers all those different time frames for buy downs. Some of them just offer a 2 year buy down. Or
What
3.
does movement offer?
We have all 3. So we do a 1, a 2, and a 3. So they all operate a little bit differently. And that'll be something, you know, for buyers to ask their lender is like, you know, to make sure if I refinance during my buy down period, that money goes towards my principal balance, right? So,
Why do you say that it doesn't make sense for the buyers to temporarily buy down the rate?
so that's a two-part answer. So the first part is if they're making the monthly payment, the higher monthly payment, or if they're paying the buy down, either way, the buyer's paying it. What's the point of doing the buy down when they could just make their normal monthly payment?
Yeah.
Where it really makes sense is if somebody else is paying the buy down.
Okay.
For the temporary.
Yeah.
Another issue that we've run into is we got clarification last summer from Fannie Mae and Freddie Mac that this is the buy down money. If a buyer is paying it, it's calculated towards like their QM, which is qualifying mortgages. There's limitations to like how many fees you can charge to a buyer, right? And so because it's really just, you know, prepaid interest and, you know, they're benefiting from it later, like some buyers were paying towards it. Where I ran into that for me personally with loans that I was originating is like maybe the buy down is $5,600 for them to have a 2-year long buy down and the seller's giving them $5,000. So they would just, you know, pay the buyer would pay the extra $600 to make the situation work. It still made sense. But they came out and were like, nah, this doesn't really comply with Reg Z, so the sellers have to pay it now. So buyers can't, it doesn't make sense for them to fund it completely for the temporary buy down. But it, you know, it does if they're just paying a few hundred into it to make the situation work.
Yeah.
So.
That was good though. Explaining it.
You got it.
I'm ready to see like an actual money breakdown. Because like, and how you can utilize that as a listing agent for marketing, you know what I mean? Ready?
Next,
let's go.
okay. So buy down money does factor into the limitations of interested party contributions. So for conventional, they have this nice little chart, and essentially it says that how much the interested party contribution can be is based on how much of a down payment the buyer is going to be putting in. So the more of a down payment that they're doing, the more that they're allowed to receive from the seller. And then for the government loans, they have a pretty cut and dry limitation on it. For FHA, it's 6%. For USDA, it's 6%. My favorite myth busting for VA. A lot of people are like, oh, VA has a 4% limit. Lies. They don't.
Lies. Oh, lies.
It's 4% plus customary loan costs. So you know what that means? It's closing costs plus 4%.
Yeah.
So I love it when an agent calls me and they're like, hey, we're negotiating repairs and we're just going to ask for more money, but I know it can't be this. I'm like, get it all.
Yeah.
Ask for all the money. We will find a way to spend it. They can have it. You go get it.
Right.
I'll find a spot for it. So yes, for VA, just go for all of it.
If I'm understanding this correctly, so that would be basically saying the seller, let's just say, what that agent would be telling you, right, is like, oh, we have a 4% cap on VA. So basically they're saying the max amount that the seller can contribute for like seller concessions or closing costs is 4%, right? But it's actually 4% plus closing costs, right? Okay.
And then you should run the other way.
Huh.
So just
So really, it's not capped at all because you can go
I mean,
crazy.
technically it is,
You can go
but you can go
crazy.
crazy. Yeah.
Yeah. Okay.
But just for example, so like on a $250,000 house, 4% would be $10,000.
Plus closing costs.
Yeah.
5, 7.
Now I don't know where you're gonna find a seller who wants to or who's gonna agree to that, but you know.
But it's good to know,
Yes.
especially in a VA market.
Yes. So like,
I don't know,
it's
it's
not
interesting.
something that I would
Yeah.
stress about.
I was helping. I don't want to throw the cylinder.
Who's the lender?
He's gonna cut it out of the.
But sellers were doing, I think, like 6,000 towards closing costs, and there were all kinds of repairs. It was like 3,000 in repairs total. There's termite damage and shit. But the seller was like, "Yeah, there's a cap. Like we've hit that cap where we can't ask for anything more." And there was more that we needed, You know, I think he was using down payment assistance as well,
Mhm.
and it was a VA loan. I don't know if that changes things.
No, it's the VA's guidelines on it.
Funky stuff going on, man.
Yeah, there's some funky stuff. Yeah. Okay, we'll talk offline.
Huh?
Him and I. I want to know who. Or at least the.
He's like, he wants the tea. Okay, types of temporary buy downs. So there's a 1-0, a 2-1, and a 3-2-1. 1-0 means that for the first year they're paying on a rate that is 1% less. For a 2-1 buy down, which I would say is the most common that we see, it's going to be a 2-year long buy down. For the first year, they're going to pay on a rate that's 2% less. For the second year, they're going to pay on a rate that is 1% less. And then the third year, it's going to revert to their long-term rate. And then there's a 3-2-1, same situation. First year, they pay on a rate that's 3% less. Second year, 2%
Crazy,
less.
right?
It's awesome. Yeah.
How would that look? Because a whole percentage for me was like $200, $250.
Mm-hmm.
So a whole 3%, dude, that'd be fucking insane.
Well, now also
Oh,
consider
shit, yeah.
this. People are generally getting a raise every year, right? So, especially in the military, we know that BAS, BAH, and base pay is going to go up every year. So, as their payment adjusts higher, so does their income. So, next.
I saw you look at me like twice too. Like maybe he'll get the hint.
So, I went ahead and this is for a $300,000 loan, right? So, for the first 12 months, they're going to pay on a 4.5%. If their loan, their long-term note rate is 6.5, right? So their principal and interest is going to be $1,520 instead of $1,896. That's a significant savings,
Yeah.
right? So the monthly amount that's being pulled from that piggy bank with the temporary buy down money in it is going to be $376 to make that full payment. So the buyer pays this. This comes from the buy down piggy bank to make their entire monthly payment. Well, principal and interest. This doesn't include taxes. So the total funds for the buy down for that first 12 months is $4,513.
And that's what the seller would be contributing, correct?
Almost. So the second year, they're going to pay on a 5.5%. The monthly principal and interest paid by the borrower is still, it's about $200 less. It's $1,703. $192 comes from the buy down money to make that full monthly payment. That should be a decimal, not a comma. It is not
$2.3
million.
million.
So the total cost for the buy down for this is $6,827. That's what you would need to ask for from the seller to hook this buyer up with a 2-year buy down.
Yeah.
A 2-1 buy down.
So is the buy down, and that'd be the principal that the buyer would have had to pay if there were no buy down.
Yeah, this is
The 6.8.
So this is year 3 and on.
The 6.8.
This is what the buy down
6.5.
Yeah.
This is like.
But I mean,
Oh, 6.8.
but yeah, the 6.8 is the principal that the buyer doesn't have to pay, but was paid by the seller.
It's the interest though.
Oh, it's the
Yeah.
interest. Okay, gotcha. Okay,
Yeah.
got it.
So the
So the investors,
sorry.
So the investors don't miss out on their like investment vehicle essentially. So like when they package these loans and they sell it on the secondary market in a basket, those investors aren't missing out on their investment because of the buy
They're
down.
still
as well.
getting
Ah,
it's just coming.
it's starting to click, dude.
It's coming from this pocket
Yeah,
instead
It
of
doesn't,
this
and for
pocket.
the investor, they can care less. Okay. Did that make sense?
No.
No, it's cool, but it helps click because there's going to be a gap in the interest
Well, I mean,
for the buyer.
interest is still being paid.
Yeah, exactly.
I'm sure that on the secondary market, for all of those guys that are sitting in rooms with 14 computer screens
I know.
and we
It's
don't
just-
even know what's on them,
Yeah.
like, they're probably looking at this, and I can imagine that a temporary buy down loan might be looked at differently than a fixed rate because you're still having to trust that these people are well qualified for this higher payment,
Right.
that they're going to be able to make that higher payment whenever it comes time to. So yes, they are still getting the interest,
Right.
but Is the buyer going to be able to make that?
Right.
You know what I mean?
That makes
There's a
sense.
certain risk. It's not like they've started
But
out.
that's why they'd have to qualify
Out the
for
gate making
6.5.
Yes.
Exactly.
Yep.
Yeah.
That's why I was saying this is crazy because
It is.
like, if I'm helping these people house hunt and they're already qualified for 1900, like they are super comfortable with that, and then we're like, hey, but these people are also offering a 2-1 buy down. That'd be like, what the fuck? That's crazy.
Yeah.
Mm-hmm. And where that comes into play is like, I mean, closing costs is typically, let's just say for a VA loan, because that's, you know, what we work with a lot here. So let's say closing costs are like 6%, you know, $6,000. If they already have the closing costs and they were expecting to pay that $6,000 in closing costs and you're able to get 7 from the seller, then it's like, look, you have 2 options here. Actually, you have 3 options here. You can take that 7 from the seller and do a permanent rate buy down, which will get you to this. You could do a 2-1 buy down, which will get you to this, or you can just go with whatever interest rate is free right now and bring nothing to closing.
Right.
So that's what I mean by like that seller concession is a tool that you can use in these different ways.
Mm-hmm.
Or they could even do a 1-year buy down and have a lower payment for that first year and let, you know, the other, what's left of the $7,000 they got from the seller absorb some of their closing costs. So then they have cheaper closing costs, but they still have a lower payment during that first year. Yeah. It's cool, right?
This is cool. Yeah.
Mortgages are fun. They're sexy.
Bring in the couch.
Don't bring in the couch. Oh.
Yeah.
That's crazy.
Yeah. I think I'd be down, but it's worth it.
All right. Moving on.
Yep.
So this chart and price point is particularly. I wanted to put one up there that is specific to our market because you'll notice when Ruben clicks the next slide button,
Yeah.
these I don't know why these we're looking at $800,000 figures here, but it helps to kind of show the differences here. So how does a buy down help me qualify for my new home? So you can see here where people think, so today's market, $800,000 and at a 7% interest rate, right? So they might think they qualify for, well, things have really gone up. I only qualify for a $696,000 house now. $3,700 payment is really where I need to be. However, they can still purchase that $800,000 house if they buy their rate down and still be at that $3,700 a month mark. Does that make sense?
Mm-hmm.
So the price point can stay the same if the rate is coming down. So for sellers who are willing to, you know, they're trying to be aggressive, get their home sold, maybe it's sitting, to be like, hey, why don't we throw X amount of dollars at a buy down for buyers, because that will help open up your buyer pool. Because it's not just people who qualify for this anymore. You're, you know, bringing your house into somebody else's price range that, you know, wasn't in their bucket before.
Yeah. So
Next slide.
That's how you can leverage it. I will say, I think you got like 6 more slides, and this ends in about 9 minutes. But we can hang out a little bit afterwards, but just heads up.
Speeding it up. Okay. Can a buy down help you regain lost buying power? Same exact thing that I just went over.
Sorry.
Buyer versus seller reductions. Okay, so this is a really cool thing with as far as listings go. Okay, so today's market, $700,000 with a 6.5% interest rate, and the home is just sitting, right? So you could lower it to $675,000, and really you're only saving that buyer $143 a month by reducing your seller's sales price by a whopping $25,000, right? But if they were instead to throw that at a buy down, look, that's $528 a month less. Buyer's gonna be like, ooh.
Yeah, and it'd be paid at closing, I'm sure.
Mm-hmm.
Yeah, it's not like due diligence or something.
To get a buyer to that payment by just reducing the sales price, you'd have to shave off $92,000. Wow. Right? So it's like,
so if we had a
where
list,
can I better utilize that money?
yeah, and I'm sure the answer is yes. But if we had a listing, we're like, hey, we're thinking about this whole buy down marketing plan, and we just send you that property, you would build a chart similar to something like this.
Yeah.
You probably already have like a plug and play that Movement Mortgage gives you. Yeah. Yep. But yeah, that'd be cool because then that conversation could happen and we'd look smarter too, so we don't screw anything up, you know? And it's already kind of built out.
Well, it's also like there's options, you know? Giving people options.
What I'm worried about is like, this just isn't like common enough knowledge. So I feel like I'm gonna put in there like, so I was offering a 2-1 buy down, and most agents are gonna be like, what the fuck?
This is what you attach the link to this video.
That's where you put my contact information.
Yeah. Why does the couch keep coming up?
I don't see a couch anywhere in this video.
But it's sticky. I heard it's sticky. All right. We're going to 18.
Next slide.
I'm sorry, it is it. This is the next one.
Oh, okay. Buy down versus seller reductions. Okay, so this is going over if you were to reduce by $12,500 instead, you're still going to be saving that buyer, opening up the payment range by $306 a month. So it doesn't even necessarily have to be a massive amount of money. This is just with paying a $12,500 buy down. And again, it's up to the buyer how they utilize this. You're going to put seller concession, $12,500. They could use it towards a temporary buy down, permanent buy down, 2-1 buy down, 1-0 buy down. Like there's different ways that they can utilize it. I have a client right now who we, at the very beginning of the process, started with a buy down. We still have that in place, but there are some repairs that need to be done in the house, and the seller's already getting so much, they're not going to do repairs. So we're looking at canceling that buy down and using that concession towards paying for those repairs. Or maybe doing a 1-year buy down instead of a 2-year buy down, so that we're freeing up some of that concession to go towards those repairs.
Makes
So
sense.
yeah, it's a really cool tool that you can mold into kind of whatever you need it to be to meet the needs at hand. Another thing is if the appraisal comes in high, maybe the seller wasn't willing to, budge or give much earlier. If the appraisal comes in higher, you can raise the sales price and do more for the seller concession, and then use that towards buy down if you wanted to. Everything is about scripts. But seriously, like how good would it sound to be like, are you open to hearing a plan that would lower your interest rate and increase your purchasing power without it costing you anything extra? I think everybody's going to say yes to that.
That might be in the description of the video, like when I post it, you know?
And then there's one for...
She looks like the 70s show girl.
That's what
Yeah.
Mila Kunis.
Yeah.
And then for sellers, it's, same idea. Are you open to an approach that'll help attract more buyers to your home over others without having to lower your purchase price? Another benefit of this, I know houses are really expensive and we're all like, but the neighbors are going to be really happy if the house sells at the higher sales price, And then agents will be happy too, because what is agent commission based off of?
Yeah.
So,
Yeah, until the tax assessments came out. Everyone's like,
So that is my rundown on buy down.
yo, crushed it. Crushed it.
Yeah.
I got Jude on my mortgage.
Not necessarily. I don't know what it all,
Honestly, it was, how do I say? We had to move, and last year, 9-10 months when we were buying, it was so freaking competitive, especially at our price point, like $250 to $300.
Yeah.
It was just ridiculous. We were probably submitting offers on it was probably around 7 or 8 houses, and we just kept getting beat out. It was like they were paying